Welcome back to the channel, guys. I just wanted to do a video on the NAV side of things, or the NAV erosion. I noticed going back to videos, I hadn't done a dedicated video on this one. I'd covered it off in other videos, but never really done a specific one. So I just really want to talk about, when we talk about high yield and we talk about the NAV erosion in option income ETFs, there's always this lure of that high yield. So with covered call and put right ETFs, they attract investors with those promise of those high monthly income, as we know, often boasting yields that dwarf the broader market. But this high income can come with a hidden trade-off. Typically, it's a declining share price, or people like to call it NAV erosion. I don't. And I'll talk a little bit of why I think there's a difference between true NAV erosion and sometimes what's banded out there. So the idea is, what we're going to go through is whether it's always bad and what it means from a total returns perspective. The typical annual yields of these are typically in the 12 plus range compared to the S&P 500, which is about 1.5% in balance. So the core mechanics of why a NAV can erode typically, you've got, in the covered call scenario, you've got the capped upside. So the fund sells the right for someone to buy its stock at a fixed price, typically a strike price. If the stock soars past that price, the fund misses out on those extra gains because its share get called away, putting a ceiling on its growth potential. So as the stock price soars, shares get called away at the strike price, ETF misses further gains. Downside obligation when it comes to put rights. So the fund gets paid a premium to agree to buy a stock at a fixed price. If that stock price drops below that, the fund is forced to buy it at a higher agreed upon price, creating an immediate unrealized loss within the fund. So stock price falls, fund buys stock at a higher strike price, instant loss on the position. The third element is the kind of nuanced one of return of capital. It's a complicated one. It's not as straightforward as people think it is. So the terminology return of capital suggests that the distributions are simply the fund returning your investment money, which reduces the NAV. So basically, they're giving you more than they're earning in effect from the options premium. However, ROC isn't always a red flag, okay? It can be a complex tax classification for options contract losses. The key is whether the fund consistently pays out more than it's earning over time. And that's the key metric to think about. Okay, when we talk about strategy and how important it can be, and income shares is a good example of this, how a fund performs isn't just about market direction, okay? It predominantly is, but there are other factors. The specific option strategy employed by the fund manager is a critical factor into the risk and return profile. So this could be the strike price and the delta. So this is a core trade-off between risk and income. So being aggressive, a high delta, if they sell options close to the current stock price, which generates a higher premium, but has a much higher risk of those shares being called away or assigned at a loss. They could, of course, have a more conservative low delta, but then sell options far from the current price, but this is much safer, but it generates a lower premium. The second factor is the options time frame. So the expiry date has a major impact. We make a lot of the money that they give out in premium, the extrinsic, from a time decay element. And so they could be daily, weekly, which are more frequent income and more rapid time decay, but highly vulnerable to those whipsaw market actions with no time to recover. And we saw that early on with the income shares before they moved to the new strategy. Monthly provides obviously more premium up front and more time frame for a trade to work out, but more stable, less frequent income is generated as a result. And then finally, we've got the asset-specific risk element. And I think a lot of people are starting to move towards coming away from a single stock because ultimately they've realized that it is higher risk. You've got that extreme volatility, your fate is tied to one company's news and performance. Medium risk are more of the basket stocks concentrated in a particular sector, whether it be big tech, the Magnificent Seven, it could be a crypto basket. They're vulnerable to sector downturns, so if crypto market goes through a bear run, then you're going to get impacted by it. The lowest risk are the index funds, so the highly diversified S&P 500 as an example is more risk. It's spread across hundreds of companies and they're typically spanning multiple sectors as well. So when we talk about it from a market condition perspective, again, this is another dimension to everything. The ideal scenario for these types of funds is typically a sideways or a fairly flat market. So cover calls are perfect. The underlying stock doesn't rise enough to get called away. The fund collects the full option premium and it generates maximum income while the NAV remains pretty stable. The put right impact is also perfect. The puts sold by the fund expire worthless as the stock price stays above the strike price. The fund keeps the entire premium, boosting income with no capital loss. Slightly an upward market. So cover call impact is again very positive. The fund captures some stock appreciation while also collecting the option premium. If the rise is modest, the shares don't get called away, resulting in growth to both the NAV and the income. The put right impact is optimal. Again, the put rights expire worthless far from the strike price. The fund collects the full premium with zero risk of being assigned the stock. This is where things go the other way. Strong upward market, cover calls, so significant underperformance now. The gains are capped at the shares are called away at that strike price. The funds miss out on most of the market rally and the total return will lag a standard index fund substantially. The put right impact is positive. The sold puts expire worthless, allowing the fund to pocket the premium. However, the small gain from puts doesn't compensate from the large missed gains on the covered call side. In a slightly downward market now, covered calls, the premium impacts as a cushion. So the NAV of the underlying stock may dip, but the income received from selling the call offsets this loss slightly. Not always by the full amount typically, but a little bit of hedge. Potentially keeping obviously the total returns flat or slightly positive. In the put right impact, the risk begins to appear now. The stock price may fall below the put strike price. The fund may be forced to buy the stock at a small loss, but the premium collected can often cover this, resulting in a minimal net loss or break even on that position again. Now, in a strong downward market, so cover call impact, the premium cushion is negligible against a large drop in the stock value. The fund's NAV erodes significantly along with the market. The put right impact, the worst case scenario, the fund is obligated to buy that declining asset now above the market price. The premium is still collected, is insufficient to offset that large capital loss, leading again to severe NAV erosion. So any kind of severe downward trend is going to be bad for any option strategy. Okay, and we're going to expect that the amount of premiums that we're going to generate, and also similarly not only the premiums, but obviously we've then got that downward impact on the NAV as well. When we talk about the whipsaw, often this gets turned and bandied around, and I just want to clarify what this means. So the whipsaw is a market condition which is volatile, so it's going up and down very quickly. So the danger is a stock can drop, trigger a loss on a put, and then the recover after the short-term option has expired, it locks in that loss. So one of the strategy changes that is happening with income shares is they're now closing a position once they've realized most of that time decay element, okay, to try and prevent this kind of whipsawing action impacting them as much. And obviously, conversely, a stock can surge, get called away, and then fall back, meaning that you've got the funds sold low and missed the chance to hold through that volatility. So it's a 1,000 cuts kind of situation on a NAV. And we saw this a lot with income shares in that underperformance on the highly volatile ones like Coinbase, where this constant whipsawing really started to hurt them as lots of news was coming out in the markets, etc. So the big question is, are you losing money with these? And the answer is not necessarily. NAV erosion is only half the story. The key is to compare the ETF's total return, so that's the share price change plus the distributions, to its underlying benchmark in different market conditions. As the chart shows, these funds can outperform in flat markets, but will likely underperform in strong bull markets. Another kind of warning, a lot of people will find this a little bit confusing, and I always recommend getting a tracker. I built my own tracker, and there's also other ones out there like Snowball, etc., that are pretty good. The challenge with your broker is they will show profit and loss on your position. They won't typically show total return. So most broker accounts will show your profit loss based on the ETF share price change. So most of the time, this number will always look negative. So you've got to either manually add those distributions you receive to this figure, or use some kind of tracker which will add it back in to give you a true total return. Otherwise, it's always going to feel like you're down. Okay. And so that's a really important thing. I get a lot of people comment saying, oh, I'm down 20K. And then I say, how much distributions have you got? And they say, oh, I've got 25K of distributions. So I'm saying, okay, you're 5K up in total return. So again, this is a really important fact to bear in mind when you're looking at these types of funds. Are there any kind of hidden risks to bear in mind? There are, and this is most critical long-term risk is when we look at NAV erosion. Option premiums are typically a percentage of the underlying share price. So as the NAV erodes, the share price falls, which directly reduces the dollar amount of the premium the fund can collect from selling new options. Okay, and this is why we see as the NAV drops, the annual distributions are also in line with that and can also drop. This creates a downward kind of spiral momentum. So a lower capital base generates less income, which can lead to further NAV erosion. And if distributions aren't covered, further reducing that future income potential. The chart on the right here just illustrates how a steady falling NAV leads to a decline in the actual dollar distribution per share, even though the percentage yield may be consistent. Okay. Now, this all sounds very doom and gloom right now, but is there a way for a NAV to recover, or does it always spiral? It's not always a one-way street. A NAV can recover. So while the mechanics of an option strategy can lead to erosion, just by the fact that they're transferring capital from the NAV and giving it to you. Notice I'm using the word transfer of capital. And that's why it's not true NAV erosion, because they've taken the money out of the fund and all they've done is transfer that money to you. So imagine if they were to earn $1 in options premium and they distribute that $1 premium to you, the net status has not changed. It's not always the case that when we see that decline on X date as an example, it's actually a bad decline. A declining NAV is also not permanent. So several factors can cause an ETF's NAV to stabilize or even increase over time. So we've got the asset appreciation. So if the underlying stock rises in value and aren't called away, the NAV will increase. Okay. And we can see that with covered call funds. We can now see that with income shares having that 25% portion of their fund in the underlying, which is now fully uncapped on a weekly basis. We're really seeing this week, we saw Nvidia rise by 5 to 6%. So this is the week of the 15th of September 2025. We saw Tesla rally and they captured a majority of that upside, which was good to see. So this is obviously most likely in a slightly upward market where the fund can capture both the stock gains and the premiums. Another impact is capital inflows. So when more investors buy into the ETF, then the fund's able to increase its total assets. So this demand supports the share price and provides new capital for the manager to deploy. However, it leads on to the very last box now, which is getting that capital is one thing, but if we're still in that downward spiral aspect, you've got more shares to distribute out based on that new income, the strategy is also quite key. So in an ideal flat or sideways market, a skilled kind of manager can consistently collect those premiums without losing much capital. And a streak of these successful trades will directly boost the NAV. So we've seen over time how income shares has changed and evolved its strategy to include the ladders. We've seen the 25% portion. We've seen many changes that they've made, moving from calls to puts, etc., to try and give that element of getting the good income without having a massive impact on the NAV and getting ultimately the key. And we'll talk about the key aspects of this in terms of total return in a second. But I just want to call out that a strategy can be over-engineered as much as it can be under-engineered as well. Almost doing too much is just as bad as doing too little. And so it's a really difficult balancing act for fund managers because they can't predict the future, they can't predict the markets, and they're obviously doing it on single tickers in some cases, which makes it even harder from a volatility perspective to predict what to do. So let's jump into the final thing around the key takeaways for investors. So number one out of all of this is calculate your true return. So don't trust your broker's default profit and loss. Hopefully, I'd hope one day we can get to a point where brokers will be able to show you your true total return, which includes those distributions. But don't forget to manually add those distributions to your share price change to find your actual total return. If not, use a tracker. I've got one as my dashboard, but also use Snowball. There's many out there. Just use those so you get a true view. Know your fund strategy, right? So is it conservative? Is it aggressive? Does it use weeklies? Does it use monthlies? Is it based on index, a basket, a risky single stock? In this particular case, the prospectus is your friend, okay, and their website, of course. Match the strategy to the market. So these ETFs are tools for specific conditions, primarily flat to slightly upward markets. They are not traditional buy and hold forever investment, like maybe an index fund, like a VWRP, or like an all world fund in effect, or an index like a FTSE 100 or an S&P 500. You do need to keep an eye on these, particularly the single stock ones for sure. Note that the future income may decrease. Persistent NAV erosion will likely lead to lower dollar amount distributions in the future. And again, we've seen that with these funds. So factor this into your long income planning. I know a lot of people think, oh, I can put 100K into this and I'm going to get a 50% yield. And so, I don't need to ever work again. It's not as straightforward as that. And we just need to be conscious of the fact that as these NAV declines, the payments go down as well. So you need to offset this. A lot of people are doing a balanced strategy of where they're taking some of the income out, reinvesting a portion back in, and taking some in growth. And I actually did a video around the income growth side of things. So go watch that if you haven't already. It covers this in a bit more detail. And then the final thing to think about is the NAV is not a one-way street, okay? The NAV can and does recover. We've seen that with income shares. We've seen that with some of the yield max funds that have come over. So look for periods of NAV stability or growth as a sign that the fund strategy is working in the current market environment. Okay, so there you go, guys. Hopefully that was really useful. I noted I hadn't done one specifically around NAV erosion, even though I touched on it in a lot of videos that I've done in the past. So hopefully this one dedicated around this makes sense. Let me know in the comments whether there's anything else you would like me to cover. Let me know if this all made sense to you guys. Note that this is just for educational purposes only, and doesn't constitute as financial advice. Okay, thanks a lot, guys. I will catch you on the next one.